Common investing mistakes beginners make and how to avoid them. Hey everyone, welcome back to Finance Clarity. Let me ask you something that might hit a little close to home. Have you ever made an investment decision that, in hindsight, you realized was a mistake? Maybe you bought a stock because it was going up fast, sold something in panic during a market drop, or put too much money into one investment without thinking it through. If you have, you're definitely not alone. Here's the reality. Most people don't become good investors because they read the right books or took the right courses. They become good investors because they made mistakes, sometimes expensive ones, and learned from them. The problem is, some of these mistakes can be very costly, both financially and emotionally. They can set people back years in their wealth-building journey, or even cause them to give up on investing altogether. The good news is that many of the most common investing mistakes are predictable and avoidable. If you know what they are and why people make them, you can significantly reduce your chances of repeating them. In this video, I'm going to break down the most common investing mistakes beginners make and, more importantly, show you how to avoid them. I'll share practical advice and mindset shifts that can help you invest more wisely from the start. If you want to learn from other people's mistakes instead of making all of them yourself, stick around. This video could save you a lot of time, money, and stress. Let's get into it. Why beginners make so many investing mistakes. Investing is emotionally and intellectually challenging, especially when you're just starting out. There are several reasons why beginners tend to make mistakes: lack of experience and knowledge, emotional decision-making, fear, greed, FOMO, overconfidence after early successes, influence from social media, friends, or financial media, trying to get rich quickly instead of building wealth slowly. Most of these mistakes are not caused by a lack of intelligence, but by a lack of experience and the right mindset. The encouraging part is that with awareness and better habits, many of these mistakes can be avoided or minimized. Mistake 1. Not starting to invest at all. One of the biggest mistakes beginners make is simply not investing because they feel they don't know enough, don't have enough money, or are too scared of losing money. Why it's a problem? By not investing, you miss out on the power of compound growth over time. Keeping money in cash or low-interest savings accounts for too long can actually be very costly in the long run due to inflation. How to avoid it? Start small. You don't need a lot of money or perfect knowledge to begin. Even investing small amounts regularly can make a big difference over time. Focus on learning as you go, rather than waiting until you feel ready. Mistake 2. Putting too much money into one investment. Many beginners concentrate too much of their money in a single stock, cryptocurrency, or sector because they feel confident about it. Why it's a problem? If that one investment performs poorly, it can cause significant damage to your overall portfolio. This is especially dangerous when you're just starting out and don't have much capital to recover from big losses. How to avoid it? Diversify your investments from the beginning. Spread your money across different companies, industries, and asset classes. For most beginners, using broad index funds or ETFs is one of the safest and simplest ways to achieve good diversification. Mistake 3. Trying to time the market. Many beginners try to buy investments when they think prices are low and sell when they think prices are high. This is known as market timing. Why it's a problem? Consistently timing the market correctly is extremely difficult, even for professional investors. Most people who try to time the market end up buying high and selling low, which hurts their long-term returns. How to avoid it? Instead of trying to time the market, focus on time in the market. Invest regularly over a long period, dollar-cost averaging, and stay invested through market ups and downs. This approach has historically produced much better results for most investors. Mistake 4. Panic selling during market downturns. When the market drops sharply, many beginners panic and sell their investments to avoid further losses. Why it's a problem? Selling during a downturn locks in losses and often causes investors to miss the recovery that typically follows. This behavior is one of the main reasons why the average investor underperforms the market. How to avoid it? Have a long-term perspective and a written investment plan. Remind yourself that market declines are normal and temporary. If your investment strategy is sound, staying invested through volatility is usually the better choice. Mistake 5. Chasing past performance, FOMO. Beginners often invest in whatever has performed well recently. Whether it's a hot stock, cryptocurrency, or trending sector, out of fear of missing out. Why it's a problem? Investments that have performed extremely well in the recent past are often expensive and due for a correction. Buying based on past performance frequently leads to disappointing results. How to avoid it? Focus on your own investment strategy and long-term goals rather than what's popular right now. Avoid making investment decisions based on what everyone else is talking about. Mistake 6. Ignoring fees and costs. Many beginners don't pay enough attention to the fees they're paying on their investments, such as expense ratios, trading commissions, or advisory fees. Why it's a problem? Even small fees can significantly reduce your returns over time due to the power of compounding. High fees are one of the most reliable ways to underperform the market. How to avoid it? Choose low-cost investments whenever possible. Index funds and ETFs with low expense ratios are often excellent choices for beginners. Be aware of all the costs associated with your investments. Mistake 7. Taking on too much risk too early. Some beginners take on high levels of risk because they want to grow their money quickly, especially when they see others making big gains. Why it's a problem? Taking too much risk early on can lead to large losses that are difficult to recover from, especially when you don't have much capital yet. It can also cause emotional distress and poor decision-making. How to avoid it? Start with a moderate level of risk that matches your financial situation and emotional comfort. As you gain more experience and build more capital, you can gradually adjust your risk level if needed. Mistake 8. Not having a clear plan or goals. Many beginners invest without a clear idea of why they're investing or what they're trying to achieve. Why it's a problem? Without clear goals and a plan, it's easy to make inconsistent decisions, chase short-term trends, or give up when things get difficult. How to avoid it? Before you start investing, define your financial goals and create a simple investment plan. Know your time horizon, risk tolerance, and what you're investing for. This gives you a framework to make better decisions. Mistake 9. Overtrading and constantly changing investments. Some beginners buy and sell investments frequently, trying to find the best opportunities or reacting to every market movement. Why it's a problem? Frequent trading increases costs through fees and taxes and often leads to worse performance. It also makes it harder to benefit from long-term compounding. How to avoid it? Adopt a more patient, long-term approach. Make thoughtful investment decisions and avoid making changes based on short-term market movements or emotions. Mistake 10. Ignoring the importance of saving and cash flow. Some beginners focus only on investing while neglecting to build good saving habits or manage their cash flow properly. Why it's a problem? You can't invest money you don't have. Without consistent saving and good money management, it's difficult to build meaningful investment capital over time. How to avoid it. Focus on increasing your savings rate and managing your spending before trying to optimize your investments. Building strong saving habits is often more important than finding the perfect investments. Final thoughts. Making mistakes is a natural part of learning to invest. However, many of the most common and costly mistakes beginners make are avoidable with awareness, better habits, and a long-term mindset. The investors who succeed over time are usually not the ones who never make mistakes. They're the ones who learn from their mistakes, or better yet, learn from other people's mistakes, and adjust their behavior accordingly. By understanding these common pitfalls and actively working to avoid them, you can save yourself a lot of time, money, and emotional stress on your investing journey. Remember, good investing is less about being perfect and more about avoiding major mistakes while staying consistent over the long term. Thanks for watching. If this video helped you understand common investing mistakes and how to avoid them, please like and subscribe for more beginner-friendly investing content. Drop a comment below and let me know which mistake you've made or are most worried about. I read every comment. I'll see you in the next video. Take care.